Lorraine. Thanks, Lorraine. And do we have Jerry Abrahams?
Here.
Tim Hodges? Kathy McKinnon?
Here.
George Perez? Franklin Perry? Sarah Sanders?
Here.
And Gwendolyn Thames? So we do have quorum.
3 is a quorum. Okay.
Tim Hodges is on.
And here's Tim.
Oh, great.
Sorry, I'm late.
Thank you. And so we have 2 resolutions and several reports. First resolution over to Hazim for a new bond sale.
Good morning, everybody. The first resolution that we are seeking for board approval is to authorize CHFA to issue 500 million of the Housing Mortgage Finance Program bonds. The sale will allow CHFA to raise 100 million of lendable proceeds for its first-time homebuyer program, take advantage of the current low interest rate environment by refunding about 143 million of outstanding single-family bonds, 57 million of outstanding multifamily bonds, and to reduce its exposure to LIBOR by refunding about 200 million of outstanding index bonds. CHFA contemplates 3 separate closings, 1 in September, 2 in October. Morgan Stanley and Bank of America have been assigned to act as book running managers for the bonds. I'll be happy to answer any questions the committee may have.
Are you refunding the LIBOR index bonds with fixed rate bonds or a different kind of variable rate bond?
We are refunding it with also another index bond. So per the memo, we are converting LIBOR to the Bloomberg short-term bank yield bonds, which is also called as BSBY. This is currently being considered by banks as an alternate index and is gaining steam.
And do you often have co-book runners? I thought you usually just have one book runner. But
Oh, it's one book runner. So because we are going to sell separate sale, so Morgan Stanley is going to work on the single family transaction, and then Bank of America is going to work on the multifamily transaction.
Any other questions from anyone else? Okay, with that, I'll take a motion.
Also move.
I'll second.
Thank you. And a roll call vote.
Jerry Abrahams?
Aye.
Okay, 1 second, folks. Hold on. Get some- Tim Hodges?
Aye.
Kathy McKinnon?
Aye.
George Perez?
Yes.
Franklin Perry?
Yes.
Sarah Sanders?
Aye.
And Gwendolyn Thames?
Yes.
Okay, it's unanimous.
Thank you. So the second resolution we are seeking the board to approve is in regards to another credit facility. The idea of this credit facility is to help CHFA manage its interest expense and preserve volume cap and tax exempt authority. Last March, the board approved CHFA to enter into a credit facility with a not to exceed amount of 75 million. CHFA entered into an agreement with US Bank, and it allowed CHFA to borrow at a very low rate. The current borrowing rate is less than half of 1% or 50 basis points. The new request, if approved, will allow CHFA to procure 1 or more facilities with an aggregate amount of not to exceed 100 million and the term not exceeding 3 years. I'll be happy to answer any questions the committee may have.
Hazim, I'm sorry, and that rate, is that fixed over the 3-year term?
No, it's variable.
It is variable, and it
Yeah.
floats based on what?
Is float based on LIBOR plus a spread, and resets monthly.
Okay, and you're not concerned that with the LIBOR transition, 3 years LIBOR we're confident that we're gonna, that the index is gonna perform as expected 3 years, given just the uncertainty over LIBOR? Like, we're getting rid of our LIBOR
Yeah,
index
we
funds.
right. We do have a facility to terminate if in an event the vehicle is not performing the way it's intended. Also, keep in mind, this is not supposed to be a long-term financing. The 3 years is just trying to say that any facility that we entered into will not exceed 3 years. So the idea is just to borrow short to park the dollars and then finance it with long-term financing.
Right, so right, exactly. That's a good point. And then, so really, all we're really doing here is waiting for the pipeline to fill to do a private activity bond deal. So we can,
Absolutely.
right, just because we have the mismatch on the prepayments and getting ready to reallocate our private activity bond.
Right,
deal.
right. Yeah, so this is not long-term financing. Yep.
Tim, this is George. I have 2 questions.
Yes.
One, I mean, it says up, you can have multiple, but you're not planning to have multiple lines, right? This is like a line of credit.
Yeah, yeah, it can be 2. So for example, if in an event when we issue the RFP, a provider essentially says we can only offer 50 million instead of the 100 million, then we may enter into 2 separate agreements with 2 different providers.
Wouldn't it have to be easier and less costly if you simply have a line of credit that is up to 75 million and then you could use it and pay it down as you use it?
That's what it is.
So help me understand when you say two facilities.
2 facilities from the standpoint of if we do need to draw an amount, say 100 million, but one provider can only offer 50 million. So we will pursue and get 100 million from 50 million from each to get to the 100 million.
Okay, that's that's different than what I understood. I understood that at no time we're going to have more than $75 million outstanding.
So this is a new authorization. So the 75 million we've already utilized. So if in an event that from here going forward, and if we need to access up to 100 million, we have another facility prior to us paying back the 75 million that the board approved from March.
Okay, the silence is because I'm trying to understand what you're saying, because and maybe, I'm not saying that you did anything wrong. It's just the way I understood it. The way I understood it is that in essence, we're getting a line of credit of $75 million, and that's what we're approving to you, up to $75 million, period.
That was the one in
aggregate,
March, correct? Yes.
So if that's the case, then you cannot go over $75 million, whether it's one facility or 10 facilities.
Right, for the authority from March, correct.
No, because you're saying to me that if you have an issuance and you need 100 million, you could do 50 and 50. So that's 100. That's not 75.
So Commissioner, let's take a step back. So the authority and the approval that we received from the board last March allowed us to enter into an agreement of 75 million. So we did that.
Mm-hmm.
Now we are going back to the board and say we need additional capacity. So that's essentially what we are asking.
So you'll have 175 million of total bank
Right.
borrowing authority.
Correct. But I'm viewing this as 2 separate authority, because I didn't want to go and say I want to add up to the 75, because I feel like the 75 is just for tracking purposes. It's easier for us to say we already received one authority for the 75, we utilize it, and then we're not going to amend that resolution. We're just going to seek for a separate authority of 100 million.
Also, LIBOR is an index that has been recommended to phase out. So imagine that if that happens, the documents will simply say a similar one would take its place.
Yes,
Okay,
that's correct. So when we did the first request for bids, we did receive responses from the providers that say, okay, if we offer you LIBOR, it has to sunset prior to June 2023. And we did also ask them to provide us bids using different indices.
right. And we all expected that they'll be similar. I mean,
Yes,
there shouldn't be more than a few bucks apart if there is any difference.
correct.
All right, so basically, I'm gonna restate what I thought I heard. Basically, this is something we approved before, but instead of a $75 million aggregate, now it's $100 million aggregate.
Right, but it's separate. So just like what Sarah said, so if approved by the board, we will end up with a 175 million authority, but under two separate resolutions.
How did we use the last one? Do we maintain a balance on it? Did we ever had a,
Oh, we
zero balance?
just did it. So we entered into an agreement with US Bank earlier in the month, and then we drew down the 75 million, and we acquired 75 million of prepayments and utilized the line to pay off 75 million of bonds. So currently there is an outstanding borrowing of 75 million by CHFA, back with 75 million of cash from prepayments.
And your best guesstimate, when will you be paying down that 75 million?
Spring of 2022.
So you plan to keep it for almost a whole?
About
like
6
9
months. Yeah, six to 9 months.
And that's because of waiting for the bond sales to happen, or?
Yes.
Okay. I'm all set.
Hazim, one more question though. What are the fee, what's the undrawn amount fees? Or is it
20 basis points,
okay? And that's on the entire amount.
entire amount.
And okay, so and the 100, how did you come up with the 100 million?
The 100 million based on what we believe we would need. We probably will not need the whole 100 million. It's just more like a safety net for us.
Right, but you pay for what you don't use.
Right. If we decide to procure 100 million.
Oh, so you're looking for board authority for up to 100 million, but you may elect to do slightly, you may elect to do less.
Correct.
Got it.
I just want to make sure I understand this right. If we don't use it, we don't pay anything, right? Or is there like a?
If we enter into an agreement for 100 million, for example, then yes, there is going to be a commitment, what's called a commitment fee, because the bank is holding a certain amount on behalf of CHFA.
But if we don't use it, meaning if the balance is zero, there is no like monthly fee or anything like that, right?
There is.
No, there is. That is the commitment fee.
Okay, I got it.
Yeah.
So really, and how do we, when the bond people that sell bonds for us come to us and give us a rate of return, we take into account the cost of this money, right?
Yes.
So has to use an example. If the average net rate is 2.5, we add the 20 basis point and whatever interest we paid during that time to that to come up with a true rate that those bonds are costing us.
Right. There is going to be a computation for the cost to carry.
Okay.
Yeah.
So you didn't really utilize these lines in the past, is that correct? This is kind of a new strategy that you're using, both of these lines?
No, we have been using it in the past, but we didn't use a line. So what we did in the past was we would essentially issue short-term bonds, in lieu of the line of credit. And at the time, because we were issuing bonds so regularly, it was deemed efficient. But then when we were talking to CSG, when they were working on the capital study, and when they were assisting us in framing the single family program and what we can do for the program, they noted that there might be a less costly way to preserve the balance cap than issuing bonds, because when you issue bonds, as you know, you include rating agency fees, bond underwriters fees, lawyers fees, and so on and so forth.
I think it's a very low cost method, and I note that you say it's primarily needed because of the elevated prepayments and slow new loan reservations. So
Right.
I think it makes
So the
sense.
goal here is when we work on the next deal, which is part of the 500 million issuance, once we close that deal, if we continue to see prepayments, we are going to use this facility to preserve until we work on the next deal in 2022. If in an event we don't need it, then we can always, skinny it down.
Sim, this is George. I have another question.
Sure.
When you select the bank or the
Yes.
entity, do you do any kind of bid? Do you, I mean,
Yeah.
US
So
Bank is a great bank, but I'd be more happy if you told me it was a bank's, headquarters in Connecticut,
Understood. So yes, there is a bid process. Lamont, Bob and his team would do it on our behalf because they are our financial advisor. So we are going to do a similar process for this next facility if approved by the board.
Hello, did I lose you?
No, I
Okay.
hear you.
So, and of course, we take into account things like CRA. I mean, if it's a bank who felt CRA, we don't do business with them, right?
Correct.
Okay.
Any other questions?
My only thing is, I just want to make sure that Bob or whoever is helping us, that they assure us that they make sure, take whatever steps necessary. Obviously, at the end of the day, it should be the best financially for us to try to give Connecticut banks whatever chance for them to be able to bid on it, meaning that they know about it,
Yep, we'll do that.
because I could be honest with you, I didn't know. I mean, I knew we'd doing this because I'm in the board of CHFA. If it wasn't for that, I would not know about it, right? And not that I'm a banker, but I do regulate banks. And stuff like this, I would normally get questions on it, And I'm not saying you haven't done it. I just want to make, go on the record saying that I really want to make sure that the record reflects that I'm approving this, and I'm making a condition that it has to be a Connecticut bank, but I want to be assured that we're going to take whatever necessary steps that Connecticut banks know about it and they have a fair chance to bid on it.
Sure.
Yeah.
I would say, Commissioner, I did try to engage Webster Bank on another facility that we bid. So we'll see whether or not they were going to respond.
Yeah, no, I mean, there's a couple of other banks in Western will be a great choice that, headquarters in Connecticut that are big enough to be able to handle this,
So just so that I understand, you, Hazim, you're estimating that using this facility, borrowing $100 million would result in about $167,000 a month savings, interest savings to CHFA.
At least.
Yeah.
Yeah, at least.
Okay, any other questions? May I have a motion?
So move.
Second,
Second,
roll call?
Jerry Abrahams,
Aye.
Tim Hodges,
Aye.
Kathy McKinnon,
Aye.
George Perez,
Yes.
Franklin Perry,
Yes.
Sarah Sanders,
yes,
Glenn Fames. Are you there, Glenn?
I am, yes, sorry, just looking for the unmute button.
Is that a yes?
Yes.
Okay, thank you. Unanimous.
now we have several reports. The first one's Allison Murphy, financial report.
Good morning, all. Before you are the June financial reports. On the revenue side, mortgage loan and investment interest revenue are coming in 8.7 million below budget for the first 6 months of the year and 7.9 million lower than prior year. The year-over-year variance continues to be mainly driven by a net reduction to the authority's program assets, resulting from lower single-family production and higher prepayment rates. In addition, short-term investment rates are down significantly from last year. As I mentioned last month, the APR of the state short-term investment fund went down to essentially zero during the month of May. However, that did rebound the last week of June. So during that time, the authority was actively reallocating funds invested in STIF to higher yield securities. Fees and other income are 7.1 million over budget to the end of June, and a substantial portion of that is due to the sale or payoff of a multifamily project from the state's acquired portfolio. On the expense side, bond interest expense is below budget by 11.8 million for the first 6 months of the year and 10.6 million lower than prior year. And I won't get into that. It's the same reason as last month. Administrative expenses are coming in 3.8 million under budget and 542,000 higher than last year. When you exclude salaries and benefits, or 12.4 million, the current year-to-date expenses are $418,000 higher than prior year's admin expenses. The majority of that variance is foreclosure costs. And lastly, the change in net position is above target by 14.5 million. Are there any questions?
So any progress with or effect from our DAP and the other steps we took as far as single family loan production? We're really not seeing any effect.
You know, production is still down significantly from last year. I looked at the stats from Sherry's report. We're down about 50%. So we're not seeing a lot. I think it's still a serious inventory problem, and John might be able to talk a little bit more about that.
I mean, yeah, it is for all the reasons that we've been talking about over the last few months. It is primarily an issue over lack of inventory available for target market.
Hasim, I have a request. It's not a question that as Allison was speaking, it came into my mind. This reminds me when she talked about mortgage-backed securities, right?
Yes.
And I don't know if the whole entire committee be interested in this, but if they're not, I'm definitely interested in somebody educating me in the process that we go through in selecting those mortgage-backed securities, because this reminds me what happened in 2008. Not for CHFA, but for the industry as a whole, right? You know, prior to that, we were in a similar situation where there was a lot of refinancing, there was a lot of loans, and people were, you know, chasing the return. And I'm not saying that that's what we're doing, that's what was happening. Then all of a sudden, in 2008, the whole thing falls apart, and we had one of the worst financial crises. And it was mostly, the big culprit was mortgage-backed securities. In fact, the biggest fine ever in the history of the state, the individual fine, was to a RBS, and it was around mortgage-backed security, and that was done by my agency. That's not the biggest fine that the state has ever got as part of a state coalition, like the tobacco settlement, and now the drug settlement is going to be big too. But the most individual specifically was that. So I really would like to better understand, and I'm not saying that we should do that today, because this is like when we did some of the other stuff that you've done for us to educate us. But I really would be interested to better understand what our financial advisors and we as a whole do in selecting those mortgage-backed securities, and what's the due diligence that we do in selecting the entities.
So Commissioner, just to make sure you are aware, so when you mention about RBS, if I'm not mistaken, in those situations, the mortgage-backed securities that you mentioned are mainly private label securities. For CHFA, when we mention about mortgage-backed securities, is essentially our first-time homebuyer loans. And the only thing what we are doing is we are taking those loans and then we are wrapping it with another protection, another insurance to ensure that the agency is protected from any delinquency. So the protection is being provided either by Ginnie Mae, which is full faith backed by the US government, or Fannie Mae or Freddie Mac, which is a government-sponsored enterprise. But I'm happy to explain, in terms of how we go about running the program and how a loan becomes a mortgage-backed security and why it does not become a mortgage-backed security. So I can make that presentation or education or training.
Okay, look, I don't want to get into the debate, but if I had a tape recording and I tape recorded several companies that went under, not the least Payne Weber, and even Golden Sachs almost went under, and I tape recorded Congress back then, where everybody thought that they had insurance, right? AIG insure a lot of this. Well, those insurance don't mean nothing if those companies declare bankruptcy, right? So if you tell me, and I consider you to be extremely bright and consider you to be one of the smartest people I dealt with in the financial world, that there's no risk from that, your stock of my book is going to go down. Yes, I agree with you that the risk is very minimal, but all those insurance, and if you remember, Fannie, or the way I like to call it, freaking frack, almost went down, right? And the only thing that survived was because the government took over them. And if you remember, they had to put an oversight in the whole thing. So yes, there's some safety net. But I personally want to be better educated on what we do. And if the rest of the group wants it, I think it's worth the time. But to say that we're protected, it means nothing if those companies go bankrupt.
I understood. I think,
and history has proven that.
Correct.
And if it wasn't for the stimulus plan that Congress and President Obama at the time came up with, we would have been in real trouble.
Understood.
Even then, we were in real trouble. There was a lot of layoffs and there was a lot of companies that failed.
Understood.
Because they were insured, they were protected.
Yes. Absolutely. I think just like my outreach to you, along with other community members, if you feel that any of the things that we discuss and we present to you at Finance Committee, if you require additional information, additional assistance, feel free to reach out to me and I'll walk you through the process, all of them, because my goal, my intent has always been to ensure that for committee, when you take a vote, when you discuss, I would like you to be equipped with the proper knowledge so that you understand what you're approving.
And my only point is that everybody in this committee brings a set of skill sets, right? And some of them are similar, but like, for instance, my set of skill sets and investments cannot even compare to what the Treasurer's Office skill sets is, right? You know, I imagine that they will have a skill set in that area that is 10 times bigger than mine, right? The same way from a risk and regulatory perspective, I would say that I'm the mini expert in that, you know, and so on. And we could go down with every member of the committee, and even though we have similar set of skill sets, we all have our own expertise.
I will plan on a
If
session on
George
that.
wants to be, if George wants to be better educated on this, I want in as well.
We'll plan on it for a future meeting then.
We'll
Thank
make
you.
it happen.
Thank you.
You're welcome. And anything else, you know, so like I said, you know, it's anything, any concern, any whatever it is, the only thing that we just have to be mindful about is, and then I'm looking at Terry Calderon. There's all these requirements about if we do conduct and have many members, then is considered as a meeting, then we have to explain, so on and so forth. But we'll figure something out that
No, and
works.
we should. I'm not
yeah.
suggesting that we do anything secretly.
Oh, no.
In fact, I
I'm
want the
saying,
whole world know that we did it, because in case
Right.
something happens, we could prove that we did do due diligence. We try to educate ourselves and we try to do everything right. And again, I'm not saying this because of CHFA. I'm saying this because I'm seeing some of the same, you know, the perfect storm, right? All the steps, all the things that happened, you know, prior to 2008 coming together one more time.
so why do we do this? Why to make it simple? Let's schedule something for the September meeting. We just put it on the agenda.
It's good.
Okay.
Our next report is delinquency and forbearance. From
Okay.
Chelsea.
Yeah, good morning. So for the month of June, the authority purchased 84 loans totaling $16.8 million, of which 63 of those loans totaling $12.2 million were securitized, or 75% of production. And I just want to follow up on maybe the most important takeaway point of that Hasim was making, is that all our mortgage-backed security loans are underwritten to CHFA standards and are reviewed by CHFA underwriting staff prior to being securitized. And I think that is the big distinction to what our mortgage-backed securities consist of versus what came about in the 2008 crash, where the underwriting standards became progressively looser and looser due to the competition by the securitization platforms, all competing for a decreasing amount of loans available for securitization. The remaining 21 loans totaling $4.6 million were whole loans. The average loan size was $200,000. Our June mortgage-backed security balance was $2.2 billion, which was a decline of $19.5 million over the prior month, while our whole loan portfolio through the end of May declined by 132 loans, or $19 million, with an ending balance of $1.4 billion. Our overall delinquency rate increased by 15 basis points to 3.1%, while our carrying balance of loans in foreclosure year over year increased by $1.3 million to $38 million, while the number of loans in foreclosure decreased by 2. With the month of June, the authority also funded 75 down payment assistance loans totaling $1 million, with an average loan balance of $13,300. Approximately 89% of our CHFA borrowers in the month of June took advantage of the down payment assistance program. I'd say two aspects of those metrics also point to the struggle we have with single family production, and that is that the average loan balances for the down payment assistance is much greater than it was a year ago, while the percentage of people taking advantage of the down payment assistance program is also much greater than it was in the past. And historically, it was always 45 or 50%, and again, for the month of June, it was 89%. The number of loans in forbearance for the month of May were 332, involving $239,000 of monthly P&I payments on a principal balance of $39 million, or 2.6% of our whole loan portfolio. Of those borrowers, 16% still made a payment in May, despite being in forbearance. For the month of June, the number of loans in forbearance declined an additional 21 to a month-end balance of 311 loans in forbearance. With regard to multifamily, the multifamily one new loan with the portfolio decreasing by a net of one loan to end up with 556 loans at the end of June with a portfolio balance of $1.3 billion. In terms of delinquency, our permanent loan delinquencies increased by 3 to 13, while our construction loan delinquencies remained at 1. Our overall delinquency rate and for multifamily was 2.45%. Two loans, two small $800 in P&I payments on a principal balance of $582,000. Any questions?
If there's no questions, next report is investment and swaps.
Good morning again. This is our quarterly report to Finance Committee regarding our investment and swap. So in summary, the investment report reflects a decrease in book value in the approximate amount of $193 million to $3.36 billion from the last quarter. This is primarily due to bond debt service payment that occurred on May 15. Quarter over quarter, the weighted yield to maturity for the investment portfolio went up slightly to 1.93% from 1.91%, but it's still lower than what we projected last November, and this was reflected in Allison's report for the investment income. Regarding the swap, our hedge portfolio remained the same for the quarter. The weighted pay rate decreased from 3.107% to 3.087%. And the mark-to-market value decreased from approximately negative $123 million to negative $143 million. This is primarily due to the decrease in interest rate. I'll be happy to answer any question the committee may have regarding the investment and the swap reports.
If there's no questions, we'll go on to our internal audit report. Joyce.
Good morning. Before you is the internal audit report update. It includes the audit activity that we've completed since February based on the audit plan that we presented to you in January. Starting with CHFA audits, we focused our resources in two particular areas. The first was the audit of the procurement function, which is a centralized oversight function which coordinates the bidding and the contracting for the purchase of the authority's goods and services. The focus of our review largely was on the compliance with the authority's procedures. Audit results concluded that key audit recommendations made during the review had been addressed. We also completed an audit of the first of two phases of the Emergency Mortgage Assistance Program for homeowners, known as EMAP. This phase of the review included reviewing internal controls over the application, underwriting, and recertification processes. No audit recommendations were made during this phase of the review. Phase 2, which includes a review of EMAP funding and loan servicing, is currently underway. The detailed audit reports for each of these reviews are included in your package. New this quarter, we've added a summary to the audit report format, which includes key audit tests by audit recommendation with a reference to the audit recommendation made. The intent of this document is to add perspective to the audit observations, which are included in your audit supplement, to show you how it fits into the context of the overall audit. Turning now to single family servicer compliance reviews. During the period, we completed a desk review of NORCOM, a review letter. Since the board mailing, management's responses have been received, and we are in the process of reviewing their corrective action plans and obtaining the supporting documentation to close the items. The organization services about 7% of the single-family whole loan portfolio. Based on discussions with management, finance management, portfolio management, we plan to defer the review of People's United until 2022. As the bank announced, it is being acquired by M&T Bank. The organization services about 2% of the single-family whole loans, and as of end of May, represent about 236 loans. We do have a review of Webster Bank underway at this time. Lastly, no consulting activities were performed during the period. And with that, I'd be happy to answer any questions.
I have kind of a random question about our businesses with People's Bank. There was a big article this morning about the city of Bridgeport pulling all their money out of M&T. And so this isn't really related to the audit, but do we have deposits at People's Bank? I'm just curious, Hazim.
We do not.
Okay, that was kind of an interesting article, but
Joyce, my statement is more of a statement than a question. I have roundtable meetings with all the bankers and credit unions every year. And we discussed whatever the topic of the month or any issues that we come up with. And these are with the CEOs, these are with the big shots. In your examination, if there's anything that comes up, not necessarily specifically to a bank, but in general, and that you think may be helpful for me to point out, I'd be more than happy to do that, you know?
Thank you. Yes,
You
thank
know,
you.
And I don't have to say, you know, this is specifically to CHFA or anything like that. You know, if it's something in general, whether it's in servicing or, you know, because I ask the same questions of other entities that interact with
Thank you,
them.
Commissioner.
And if
I
there's a
appreciate that. Thank you.
reoccurring issue, that's, you know, the Connecticut Bank Association is there, and these are the decision makers that we meet with in that specific time. I mean, I
Thank
meet
you.
with other people, but that specific time is, and to my shocking surprise, not only does the banks that I regulate show up, but the ones that I don't regulate actually have as good attendance, if not better sometimes.
Thank you.
questions for Joyce? Our last item is approval of the minutes from our meeting on June 24th. May I have a motion?
I'll move.
Move.
Second,
Second.
roll call.
Jerry Abrahams,
Aye.
Tim Hodges,
Aye.
Kathy McKinnon,
Aye.
George Perez,
Yes.
Franklin Perry,
Yes.
Sarah Sanders,
Yes,
and Gwendolyn Thames.
Yes.
It's unanimous. Thank you.
are there any other matters for this committee? With that, I make a motion to adjourn. All in favor?
Aye.
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 You, see you over on the other side.
Thank you all.